Yeah, hello everybody. It is a pleasure again to be back again. Or, well, to be honest, perhaps it was a lie. I enjoy to talk to you now. And we are going on with international, or better at the moment, only national inheritance tax. The introduction to Germany's Inheritance Tax Act goes on, just to give you an overview of which problems show up, which rules you might expect, and how such an inheritance tax might work. Well, and the topic of today's videos is either all or at least the first months of the following situations, depending on how long it takes. Well, the right to inherit a pension or so. Then donations which are made under holding back usufruct of the asset which you pass over. And there is also a special dramatic and tragic constellation if, let's say, a whole family dies one after another in short sequence, then it might end up with the enormous accumulation of inheritance liabilities in the hands of the last heir, which might be regarded or might be felt as very, very tragic, so that some modification or mitigation should be possible and necessary there. Well, let's begin where beginning makes sense. So let's begin at the beginning, and we are here. And first, let's think about you inherit a right to a pension. This might, for example, happen if somebody bequeaths you a legacy. So if you get now a right to a pension, let's say monthly pension of 1,000 euro, then the first problem is, well, inheritance tax asks for the total amount of what you have inherited. You need the total amount to determine the right rate of progression, to add it up with other assets to find a basis from which you can deduct free allowances and so on. So it does not help you to know that you get 1,000 euro per month. You will have to change that into a single amount of today. So you will have, for mathematical reasons, you will have to find out a discounted amount, a present value of all the future pension revenues or pension income which you are going to get. Now, when you calculate the present value, you know that already from basics of business and other things, then you need a discounting factor. You need to know the interest rate by which one discounts. That is often a question of the market interest rate. Now, if you look to the market interest rate, there is never the one and only market interest rate. So also there would be different people offering different interest rates to you. You could end up with enormous quarrels about the adequate interest rate. And so the German valuation law, which applies wherever there is no special valuation rule, says in its general part that at the moment, at least still, you have to do calculations with an interest rate of 5.5% if no other rule states otherwise. And here in our sector, inheritance tax, no other rule says it differently. So we take 5.5% as the basis for our calculations. Now, the only other information which you need to have then to calculate a present value is to know how much of the payments, how many future payments will come. So there you need additional information from the case. For example, if there is a fixed time limit, so for example, you get a pension for a fixed period of 10 years and then it's cut off and finished, then there is a table with the necessary calculating factors given as a supplement to the valuation law, where you can look that up. That is supplement 9A, referring to paragraph 13, I believe, or 14. And you can look things up. Now, there are also lifelong pensions or lifelong payments to which you are entitled or to which you are obliged. You have also to value these things. Well, and in that case, the duration, how long such a pension will be paid or received, depends on the statistical life expectancy of the person who is entitled to receive that. Well, so the problem is the life expectancy changes over time. There are always new statistics. Let's say the health situation becomes better and better, so people live longer. It might also be that wealth and health go down, and so that the life expectancy over time drops down a bit. And so a few years or 1 or 2 decades ago, the fiscal ministry refrained from setting up once and for all a table with calculating factors there. But they said, well, the life expectancy data are always updated on short term. So they turned to publishing at the beginning of each year an official table which gives an overview about the life expectancy, which has to be used for tax relevant calculations during that year. And they also publish the present value calculation factor, which results with 5.5% interest rate based on that life expectancy data. So that is published every year. I found the most recent table, that for 2021, and included that in the Tax Act Slides edition. Naturally, if you view this video in later years, the data might have changed, but not the underlying logic. So you can still use these factors from these tables in order to learn how it is done. Naturally, when you have to do in practice such a calculation, let's say in the year of 2030, you will just have to look for that actual and current table of life expectancies and calculating factors for that year. That will not be so difficult. So we can work now and in the future with these tables. Good. Let's try to understand how things work. First example, somebody who is going to die soon or has just died, dropped down dead, left everything to his spouse, but ordered her to give a monthly amount of 1,000 to his beloved nephew N for the next 10 years. The idea is, well, N is still relatively young, shall be able to grow up without financial problems, to choose the university which he likes, and do education as long as wanted, and then, or to have some holidays and see the world, and later have had fun in life, a good use, and then take up a well-paid job. So the idea is, if after 10 years N still needs financial support, then N is just a lazy bastard, doesn't deserve it anymore. But 10 years, okay, 10 years should be covered with good amount of money. That was what the deceased thought and had in mind. So that's the core information for us. There is an annual payment or a monthly payment which is paid for a fixed, unchangeable period of 10 years. Yeah. So fixed period of time, supplement 9A. Let's have a look. This is how it looks. Then we look to, well, fixed period of 10 years duration, 1, 2, 3, 4, 5, and 10. For 10 years, the multiplication factor is 7.745. Good, let's go back. So 7745, and if we apply that to the annual amount, which is received 12,000 euro, then receiving 12,000 euro 10 years has a present value under an interest rate of 5.5% of 92,940. So the legacy, which the deceased left to N, has a tax value of 92,940 for purposes of inheritance tax. This is great now. Now we have one single date figure. We can add that up with other assets. We can deduct that from as a liability from the inheritance when we calculate the amount of enrichment of the spouse. We can apply free allowances. We are absolutely happy. We have all what we need. Another example, factory owner FO dies and orders that his heirs have to pay a lifelong rent. No, pension, sorry. Germans always say rent when they mean a pension. That is because in Germany, the word pension is Rente, and so Germans will constantly mix up those. So a lifelong pension to the faithful former servant, FFS, which shall be 2,000 per month. At the moment when FO dies, the servant has already retired and has an age of 68. What is now the value of the promised pension which FFS has to claim? Well, the solution is simple. We have a lifelong payment, so we need the table which is based on the life expectancy data, sorry. So not supplement 9a, but that annually republished and updated table. Here I copied it from the TechSec slides, which you know from me. And here for 68, we have a remaining life expectancy for male persons, 15.78, and a present value factor then of 10.656. So if we want to calculate the present value, you just take the annual amount which is paid times 10.656. So annually 2,000 times 12, that's 24,000, and that is taken by the factor. So we end up with the total present value of that lifelong pension grant here, 255,744. Yeah. You can even make things more complicated. You can even solve by the help of these two tables more complicated questions. For example, if one makes up a situation like this, the heirs are by the testament of the deceased ordered to guarantee a lifelong rent to the faithful servant which formerly worked for the deceased. But now the surprise is the rent is not going to begin now. Its begin is fixed at the time when the servant becomes 65 years old and will then have to be paid for the rest of servant's life, 1,500 euro per month. Now at the moment the servant is exactly 55. So the pension payment will just begin in 10 years. Not now. How can we find the present value of that pension grant? No surprise. Well, my approach would be the following one. This is the value of this pension grant completely if it were to begin from now onwards, 55. And then we would deduct the fixed amount of the pension payments for the first 10 years, because that is what our FFS, the faithful former servant, does not get. So you deduct the value of the payments for the first 10 years. The difference should then be what remains, the value nowadays market value or tax value for all the payments which begin in 10 years and then last till the end of the life of our friend here. Indeed, if we follow that approach, we get the total value for all payments which would begin now would be 250,440. Now the first 10 years are missing, so their present value is deducted. 139,410 calculated under usage of supplement 9a because the 10 years is a fixed period of time. So the difference is our needed result. The value of all future payments beginning from the 65th year onwards till the end of life of our FFS is then 114,030 euro. The necessary factor is a factor which I took from this table here, 55 at the moment, remaining life expectancy 25.92, and the discounting factor 14.018. Oh, I made a slight mistake, but that doesn't really matter for the way how the calculation is made. Okay. By the way, here you have always one column for male and one for female persons. That reflects the well-known fact that female persons live for a longer time than male persons. A friend of mine some 20 years ago raised the question if taking that into account might not be a discrimination on grounds of sex. Statistic fellows usually would say it's just taking into consideration well-known facts. On the other hand, there has been already jurisdiction that when it comes to selling a life insurance, the calculations may not deviate between male and female sex, at least not under certain circumstances, so this matter is open. It does not interest us here. Well, let's go on. Let us now think about the tax consequences for these examples. The enrichment of the acquirer in example 1 is the value of the pension is 92,940. Now the nephew is tax class 2. There is a free allowance of 20,000 which is deducted. Remaining taxable amount 72,940. You have to round down 72,900. The tax class in that region is 15%, so the resulting tax claim is 10,941. And now N has only one problem. He gets 1,000 per month. Charged is inheritance tax of 10,000. Where can N get the money from? An immediate payment seems to be impossible. The same with example 2. The acquirer is enriched by a pension grant having a value of 255,744. Free allowance is tax class 3 because it's highly probable that the servant was not a member of the family. So 235,744 remain. You have to round down again, 235,700. The tax rate in tax class 3 would be 30%. That's approximately 70,710. That is now the tax notice which FFS gets, and probably when he reads it, he or FFS, the faithful servant, let's imagine that is a male servant. Otherwise, we would have to change the calculation. Drops down dead when he opens the tax notice. So here we have to take some consideration. We must find a way out how the tax becomes payable for FFS. Even worse, in example number 3, there is a pension with a value of 114,030. The free allowance is 20,000. 94,030, or rounded down, 94,000 is the value of the taxable acquisition. 28,209 is the tax, but the first money flows in 10 years. How can our friend here think about paying the tax? Evidently, all that seems to be impossible. We need a special idea to help these people. Well, the German legislator saw the problem and said, okay, if the enriched person only gets money in different installments year by year, then the most adequate solution would be to allow a payment year by year. So a payment of the tax in installments. You can find that described in paragraph 23 of the German Erbschaftssteuergesetz, the Inheritance Tax Act. And this rule says that the tax can be paid annually if you apply so. And then your personal tax rate, in that case 15% or 30%, will be applied to the annual amount. So that would lead to the following situation. Example 1, we found out our friend ends up in the progression zone, which is 15%. So N can opt for an annual payment of always 15% out of each annual revenue. That would mean, in the case of N, 1,800 euro per year. And now this doesn't take into account the free allowance, so the fiscal administration says, okay, N can receive the first installments free of tax until the free allowance is used up. So the 15% on each additional amount will probably set in the second year. Example 2, the appropriate tax rate, which we found out after the assessment or during the assessment of our recipient, was 30%. The annual amount paid is 24,000, so the acquirer can opt for annual payment of 7,200 for each year. Also, here again, the first payments can be received tax-free until the free allowance of 20,000 is used up. Example 3, same basic idea. We had a progressive rate of 30% correctly calculated. So the annual tax in case of annual payment would be 30% on each individual amount per year. So that would be 5,400 per year. And also in this case, you could receive or collect the first installments of your pension until the free allowance is used up. By the way, the fiscal authorities also would accept different approach that you begin with paying your taxes immediately, and that's statistically correct. The free allowance is distributed over your whole lifetime, and so that always a small amount of your installments or of your pension money which you get is lowered by the appropriate share of the free allowance, but that sounds a bit complicated, so we prepare that now, this solution. Furthermore, it might be that if you have a bit of money later and you want to get rid of that year by year payment and want to pay it once and for all to get rid of it, then you can always make the following deal. You can go to the fiscal administration, say, I want to pay the rest, and then the simple solution is they calculate the 15 or 30% on the remaining present value of all the future pension payments which you still have to expect. You can always choose that. So if in example 3, after 2 years, after, I believe the payment began with 65, so after 5 years, our recipient is a bit sick, feels bored about always having to pay inheritance tax year after year, and so asks himself, can I not get rid of that by paying off the whole remaining amount? At this moment, our recipient shall be 70 years old. So the remaining capital value, the present value of the pension claims, is the discounting factor, which refers to a male recipient of 70 years at the moment. That's 10,040 times the annual amount. That 180,720 is the remaining capital value, and 30% of that would be 54,216. So you as a tax advisor would tell our pension person, you can only get rid, or you can get rid of the future inheritance tax payment if you are willing to pay now, once and for all, 55,216. Yeah, so nice. As you will see, these problems, the problem that somebody who inherits a right to annual payments will usually not have sufficient money to pay for the whole tax at once. That problem will nearly be given everywhere. So you will have to expect solutions of that particular problem everywhere. We can reasonably expect that nearly all states which know such a problem with pensions will create a specific solution for that problem, because otherwise things don't work. Good. Now, there is another difficult thing, completely new topic. What happens if somebody hands over an asset to you but says, I reserve the right to exclusively use that asset myself until I die? This is called usufruct, the right to use an asset for a limited period of time. So you can't sell it, you can't ruin it, you have to keep it in a functioning way, but you can use it for your own purpose, and you can use the fruits of it. You can enjoy its usage as long as you live. So the problem here is you hand over ownership, let's say in a house. It's not now no longer your house, but it's guaranteed, and probably even guaranteed in the real estate register, where the ownership conditions are noted down officially, that you have a lifelong right, and the exclusive lifelong right, to use this real estate property. So the owner will only be able to make use of this property when you are dead and gone. Good. So here let's say, if you are a child and get a house from your parents, then you get ownership of the asset, but you have no right to use it during the first years. That leads to the natural consequence that naturally it would be wrong to say you get a house with a value of 800,000, because a market value of a thing which you can use naturally reflects the revenue or the income which can be produced and achieved by that asset. And now a huge part of that income, the income of all the first years, or the usage of the first years, is blocked for you. So what you got has a lower market value. So if one wants to be fair, you should establish a tax base for the inheritance tax based on a lower value than on the full value of that asset without that limitation in usage. Good. A basic approach to value that is usually simple. You find out the correct value for the right to use such an asset for the next X years, and then you deduct this right from the full value of the asset. Imagine we have a house with a market value of 800,000. Then 800,000 is, from the perspective of the market, nothing else than the discounted present value of all future usage which an owner can bring or collect from the house. Now, the owner is a 78-year-old retired accountant, and the owner passes over ownership already to his son, but keeps back the right to use that house for the rest of his life. That means the son is now immediately owner of a house. To be the owner brings along several possibilities. You can make every legal usage of the house for eternity, but unfortunately the usage during the first years, the usage during which the old accountant, the former owner, still lives, is blocked. This usage is not for you. You only have the rest. So you are an owner and you have only got the nice advantage to begin to use that house when father is dead. Well, now let's calculate how long is that period during which you cannot use the house where somebody else has this right, and how much is its value. Well, the first thing is what we have to find out. Somebody who is a 78-year-old accountant, how long is that person still going to live? That is a matter of statistics. Then you have to find out how much is the value of the right to live in that house free of rent for 1 year. And then what you simply have to do is just to multiply the value for 1 year of the right to use the house for 1 year times the life expectancy of that person and discount that over that period of time. Now, according to the table here, we can find out a male person at the age of 78 has, according to the statistics for which is up to date in 2021, still a life expectancy of 9 years and 0.24, so approximately 9 years and 3 months. And the discounting factor for annual advantage is 7.291. That brings us to the idea that if we know the right to live in that house for free, we can multiply that with that factor and get the value. Now, for reasons of consistency, the valuation law says, well, the right to use a house for 1 year cannot be higher, or we must prevent a situation where if we calculate the right to use a house or another asset year by year for eternity, then it can't be that a higher value comes out than the market value. And so they introduced a maximum, which says the maximum value for the right to use an asset for 1 year is the tax value divided by 18.6. That is what comes out if you discount and do some calculations, all based on 5.5%, and then round it a bit. Here it comes out that the annual rental value of the house is at maximum 43,010, and we just now assume that this is indeed correct, or that the monthly rental value in the market would be higher, so the 43,010 is what we need and take for calculation. Now, multiplied with the discounting factor, that leads to a present value of the right of the previous owner to use that house still for the next years. That amounts to a value of 313,585. So simple mathematics say if we got ownership of a house of 800,000, but the right to use this house is taken away from us or reserved, kept back by the previous owner, then we only get the right to use it for the time afterwards. And so simple logic says 800,000 is the right to use it for the rest of eternity, minus the value for the first, let's say, what was it, 9 years and some months. There remains the remaining value of 486,415. So far lower, and this is now our tax base. You could even modify this example to make the effect more drastic. Imagine there's parent P, and parent P is what we can call a genuine German-minded person. What is German-minded? German-minded is we all want to cheat the tax, but the German peculiarity is we want to do it in a legal way. That makes Germans so complicated. So parent P owns many houses and wants to make donations to child C in an advantageous way. I once even came across a German, later he was a professor, who even had the dogma that having a child without being able to make a donation that completely uses up the first free allowance for the first 10 years at the moment of birth of the child is under moral aspects reproachable. So P is of that character. P doesn't want to leave any tax saving model unused, and so P thinks about the following thing. When the child has just been born, P looks through all his houses, finds a house with a market value of 1 million, and then says, okay, now I go to the notary and I make my newly born son or daughter immediately the owner of that house. But I'm not an idiot. I want to keep the money flowing from the house and the right to use that house for myself for the rest of my life. And P, the parent, is at that time 30 years old. Now we have again some calculations to do. The complete value of the house all over eternity is 1 million. The right to use it for the rest of the life of parent is to be calculated as how many years is parent still to live, according to this statistic here, 41 years approximately. And that means the annual value of using the house should be taken times 16 point some digits in order to get the present value of the right to use that house from the 38th birthday until the end of life of parent P. So the child effectively only got a house with a value of 1 million minus the present value of the usage, which is kept back by parent P for the next perhaps 40 years. That amounts, if you calculate it based on the maximum rental value of the house, that amounts to 896,129 euro. And that leads to the consequence that the house here, the ownership of the house of 1 million changed, and the tax base is only 113,871. This amount is far below the free allowance for the child, so you could hand over that ownership burdened by a usufruct for the rest of life of the previous owner below the free allowance, so completely free of tax. Now, if you look to that with open eyes, you see that this is an excellent tax saving model, because at the moment ownership of the house is transferred, but the value is only approximately 115,000 instead of 1 million. But the child can only use the house when father is dead and gone. So compare that with the situation where father keeps the house and just silently dies later. That's a grave difference, because father transfers the name of owner to son or child and keeps back everything else for the rest of his life. So father's economic situation does not change at all, because son has only the title of ownership, the name, but that only becomes effective, that it becomes useful after father is dead. So no change in the economic situation here. But in the first case, where father knew the trick, ownership could be transferred under far lower taxes. This is a tax-saving model which especially rich persons can use, I presume. And the problem is, it's an idiot-proof or fool-proof tax-saving model, a loophole. Because you do not really change your economic situation. You retain the full power over the house, possession over the house, lifelong, but now your child is already named owner. And the result is an enormous amount of tax was saved because the tax base now was 100,000 instead of 1 million. This is so attractive and so unfair that it could be expected that states find solutions against this loophole situation. Indeed, in former times, Germany had found an interesting approach. They said, if you hand over an asset which is burdened or which is combined with a usufruct which is kept back by the previous owner, then this usufruct is not deducted from the tax base. So it is not regarded as a liability. The only thing which we do is, later when it comes to the total tax, we just split up which part of the tax refers to the amount which corresponds to the usufruct, and the tax relating to that only needs to be paid when later the usufruct expires because of father's death. So what you would have to do then is the child would have had, under that old German rule, to pay taxes on the 115,000, the enrichment, market value of the enrichment, which is really going to the child now. And later, when the usufruct falls away, then the child has a house which completely, now without any burden, belongs to the house. So the remaining 800,000 burden on the house falls away. So the rest of the tax is regarded now as due. Until then, it would have been postponed. That was a very ingenious and clever way to ruin that loophole. And surprisingly, when last time the Constitutional Court of Germany reviewed the Inheritance Tax Act rules and forced the legislator to abolish several privileges for donations in form of real estate. They forced Parliament to insist on valuation with market values. Then, during that reform, that paragraph 25 of the Inheritance Tax Act in Germany, which closed that loophole, was silently and without major comments simply removed. So this seems to have a very bad taste. Constitutional Court forces you, for reasons of fairness, to close a loophole which came from the consequent and constant undervaluation of real estate property. And when you are doing this, you just skip and abolish another rule which closed the loophole, and so you open an enormous loophole for everybody who is well informed. I, until now, still can't believe that this is the whole truth. I'm still waiting to find out that there is perhaps hidden in some other rule a way how this loophole can still be closed in a different way, but I have not yet found it. So, and I have checked that in the outside world, this loophole is again recommended as a proof way to save taxes. So this is rather a disappointing detection. But what I know is, and what you and I can expect, the construction that you can shift ownership to somebody else but reserve usufruct for yourself. That construction is under civil law possible also in other countries. So the idea that you can artificially lower the value of ownership at the moment when you transfer ownership, that works in other countries too. And I believe that I also have read the one or other comment on that this is treated under special rules in other countries too. They will have other rules, naturally. How to close a loophole does not always work in the same way. But it is expectable that you will find different or special rules for this constellation. if you have not yet grasped fully where the effect lies, well, just let's explain it again. You transfer the house at the moment where the market value is strongly reduced by the usufruct. So for 115,000 instead of 1 million, child pays on 1 million. Now the trick is when father dies, then a liability falls away. But the problem is the value of that liability at that moment is zero. And you have not been enriched, because what has really happened is the usufruct has simply worn down over time. It expired gradually. And yeah, so there is no additional transfer of the remaining value to you. The value of your future chances just increases over time in correspondence to how the value of the usufruct or the remaining period of the usufruct goes down, but there is never anything which is now donated or shifted from the sphere of the one to the other. That happens automatically. And so you really get enriched only by that reduced amount, and later there is never a taxable event anymore. And that is how the trick works. And every other state also, whoever comes across that phenomenon, will have to think about measures. If they do it, that depends on how much they want to enable their good friends and rich fellows to circumvene inheritance tax without that everybody notices that. But if they want to close loopholes, they will have to address that problem. Well, a last remark, another situation which might also cry for special measures. This is the case where multiple taxable events happen within short time, one after another. Well, what do I mean? Just imagine, I believe it was Louis XIV, Louis XIV of France. Shortly before he died, his son died, his grandson died, and his great-grandson inherited, all within a few years. So imagine it had not been France and the sequence, but it had been a big amount of money, and the sequence of event would have been a bit different. Imagine this: grandfather, grandmother, father, mother, and the 2-year-old child drive in a car together. Unfortunately, the car has an accident. They are all heavily injured and lie in hospital. And now grandfather dies on Monday, and under grandfather's testament, everything he has is inherited by grandmother. Now grandmother survives only until Tuesday. Now father inherits everything. So all the assets of grandfather hop over to a new owner again. Father in turn dies on Wednesday, and everything now is inherited under his testament by his wife. And now, as you already might expect, fate has a very bad humor, and wife dies on Thursday. And so the 2-year-old child inherits, let's say again, the 100 million in question on Friday morning. Now what happened here? Well, grandfather died, grandmother inherited. There was one taxable event, acquisition on ground of death, inheritance. Let's say 100 million, that will be 30% tax rate. 30% tax rate is 30 million are gone, 70 million are left over. Grandmother dies a day later, 70 million hop over to father. So father has to pay inheritance tax. Let's assume it's again 30%, that's 21 million. So 49 million are left over. The father dies on Wednesday morning, 49 million hop over to wife. The tax rate is, I believe, still 30%, 30% of 49 million is something which you and I don't dare to calculate, but let's assume it's a bit less than 15 million. So let's deduct some 14 million. 35 million are left over. Now mother dies, 30% tax rate is still applicable. 35 million, approximately 10.5 million go away again. And now we have the child awaking on Friday morning with a net property of 25 million. At the beginning of the week when the car tour started, the family still had 100 million. So according to that very tragic sequence of events in the exactly wrong sequence of events, we have now a multiplication of inheritance taxes, one by one by one. This is accumulation of inheritance tax, which, for example, a firm or a housing property could never survive. And imagine even if you hear of that sequence of events, inheritance tax, inheritance tax, inheritance tax, hey, there's nothing left over. Normally, the idea is, or usually, the idea and what we have in mind is one generation dies, the next generation takes over, 30 years later, the next generation dies. So there is always a little loss of property, and then the next generation saves up property a bit again. So gradually the wealth can recover, but this is now hit after hit after hit. And so in the end, when the child wakes up, it has inherited inheritance tax liabilities of approximately 75 million. So you will probably have to liquidate all the property within a short time. That probably forces you to sell at a lower market price than usual, which has the consequence that you even make losses from selling the stuff, and probably what you can keep is less than 25 million. This is such a tragic sequence of events that one can expect that the one or other parliament has this in mind and thinks we must mitigate such an extreme, tragic course of events. This is the only thing you need to know about that. If you want to mitigate such tragic consequences, then naturally that can only be done in an arbitrary way. So that will be done by every state in a different way, and you can only look it up. Recommendation or short hint, when that affects German law, then you would find something in paragraph 27 of the Inheritance Tax Act. Well, this was my overview about special situations which require special treatment under the Inheritance Tax Act. And this is, I think, a good idea to stop at that moment. Wish you a good rest of your day, and hope you that you come back to the next video when we are talking a bit about some remaining ideas on the German Tax Act. And in the later course of the lecture, we will then focus on genuine international problems, and before, naturally, as I hope, also on some practical cases, just to show you how cases might be solved. Thanks for watching. Goodbye. Till next time.